Black Thursday, October 24th, 1929. While brokers were jumping from windows and investors were losing everything, I was calmly collecting millions. In the next 15 minutes, I'll reveal exactly how I spotted the greatest market crash in history before it happened, and positioned myself to profit massively while others were destroyed. This single principle of contrary thinking has been the foundation of my greatest trades, and it can transform your approach to markets forever. I am Jesse Livermore, and by 1929 I had already made and lost several fortunes, but that October I made $100 million in a single day, equivalent to over $1.5 billion today, by shorting the market when everyone else was buying. Not because I was lucky, because I recognized patterns I'd seen before. The market tells a story if you know how to listen. In early 1929, I noticed something critical: the divergence between what company insiders were doing and what the public was being told. While newspapers trumpeted endless prosperity, corporate executives were quietly selling their shares. The smart money was exiting while the public was still piling in. I've always followed one principle: don't listen to what people say, watch what they do, and what they were doing told me everything. By September 1929, I had built massive short positions. My brokers thought I was insane. "Jesse, you're fighting the trend," they warned. But I wasn't fighting the real trend. I was anticipating its inevitable reversal. When Black Thursday hit, panic erupted. The ticker tape ran hours behind as sell orders flooded in. Crowds gathered outside the New York Stock Exchange in disbelief. Major financiers attempted to stop the bleeding by publicly buying shares, but it was like trying to hold back the ocean with a broom. While others desperately tried to understand what was happening, I was executing my exit strategy, covering my shorts and locking in profits. I didn't celebrate. I never do. I simply confirmed what I already knew. The market always returns to reality, regardless of how many people believe otherwise. This wasn't my first crash. I'd seen the panic of 1911, and before that, the 1901 Northern Pacific Corner. Markets change. Human psychology doesn't. Fear and greed operate today exactly as they did a century ago. I'm about to show you my complete methodology for identifying major market turning points before they happen. Not vague theories, concrete signals I've used to extract millions from the market through multiple cycles. Pay attention, because what I'm about to share could be the difference between being wiped out in the next crash or profiting from it. My rise from poverty to Wall Street legend wasn't built on luck. It was built on discipline. I grew up in Massachusetts, the son of a farmer with barely enough money to feed the family. At 14, I left home with just $5 in my pocket, desperate to escape the plow and find my fortune. That desperation taught me my first lesson. Hunger is the greatest motivator. I began as a board boy at Payne Weber, posting stock quotes for $5 a week. Hour after hour, I recorded numbers, watching patterns emerge that others missed. While they saw random figures, I saw rhythms, the market's heartbeat. This became my edge. While others relied on tips and rumors, I studied the tape. By 15, I'd made my first independent trade with saved money. By 16, I'd turned $5 into $1,000. What separated me from others wasn't intelligence, but obsession. I filled notebooks with price movements, creating my own system when everyone else followed the crowd. My method was simple. I bought when prices broke through previous resistance and sold when they fell below support. The pattern never lies if you have the discipline to follow it. The bucket shops became my training ground. These shady operations took bets against clients on stock movements without actually executing trades. They counted on emotional traders making mistakes. I beat them by removing emotion entirely. I didn't care about the companies, only their price action. This cold, mechanical approach earned me the nickname the Boy Plunger. By 20, I'd been banned from every bucket shop in Boston. They couldn't afford my winnings. That's when I realized the market doesn't reward knowledge of companies. It rewards knowledge of human psychology. Fear and greed drive prices, not fundamentals. My biggest early lesson came through failure. After moving to New York, I lost everything by ignoring my own rules. I'd developed perfect trading principles, but lacked the discipline to follow them consistently. The market punished me severely for this arrogance. I rebuilt by returning to my core principles. Never fight the trend. Cut losses quickly. Let profits run. These aren't just catchy phrases. They're survival mechanisms I developed through devastating losses. The poverty of my childhood created an insatiable hunger that drove me to amass millions. But it also created a fear that would eventually destroy me. Remember this: your greatest strength often hides your fatal weakness. My ability to accumulate wealth was matched only by my fear of losing it. This paradox defined my trading life, and it will define yours too if you don't master your psychology. Rule number 1, the preparation principle. Markets telegraph their collapses. I've made and lost fortunes multiple times in my career, but my greatest profits always came from anticipating market crashes. The market always tells you what it's going to do, if you're willing to listen. In 1907, I made my first million shorting the market during the panic. I saw the signs months earlier: credit tightening, stock manipulation by insiders, and excessive speculation in copper. While others were blindly buying, I was quietly building short positions. The market was screaming its intentions, but few were listening. I don't predict crashes through mysticism or gut feelings. I watch specific signals. First, I track divergences when the market indices rise but fewer stocks participate in the rally. This happened before the 1929 crash, when I made $100 million in today's dollars. The Dow kept climbing, but breadth deteriorated for months. Second, I monitor leading sectors. In 1929, railroads weakened first. The transportation sector always leads. When I saw Union Pacific and the New York Central failing to make new highs while the broader market advanced, I knew trouble was brewing. Third, I watch volume patterns. True bull markets show increasing volume on advances and decreasing volume on declines. When this pattern reverses, it's a warning flag. Before the 1929 crash, volume became heavier on down days. Smart money was distributing shares to the public. Fourth, I observe credit conditions. When banks tighten lending and interest rates rise, speculation gets strangled. I learned this lesson painfully in 1908 when I ignored these signs and lost everything I'd made the previous year. The preparation principle isn't about timing the exact top. It's about recognizing the conditions that precede major declines and positioning accordingly. I never try to sell at the absolute peak. That's a fool's errand. Instead, I start scaling out of longs and building shorts when multiple warning signs appear. Most traders fail because they react to crashes instead of preparing for them. By the time headlines scream panic, the smart money has already positioned itself. I made my greatest fortunes not by reacting to crashes, but by preparing for them months in advance. The market always telegraphs its intentions. Your job is to listen when others are deaf with greed. This principle saved me repeatedly throughout my career and made me millions while others were ruined. Rule number 2, The patience paradox. This might be the hardest lesson I've ever learned in my decades of trading. The market rewards those who wait, yet punishes those who hesitate. Let me explain this contradiction that's made me millions. I've made my greatest fortunes not by constantly trading, but by sitting on my hands. In 1907, I made $3 million during the panic because I waited patiently for months, watching the market deteriorate before making my move. Most traders would have jumped in prematurely, burning through capital on false signals. Patience isn't passive, it's intensely active. When I'm waiting, I'm analyzing, observing, and preparing. I'm watching volume patterns, price action, and market sentiment. I'm building my conviction while others are bleeding their accounts with impulsive trades. In 1929, I observed the market for nearly a year before placing my massive short positions. My patience allowed me to see what others couldn't, the inevitable collapse that would make me $100 million. Had I rushed, I would have been squeezed out like countless others who timed it wrong. But here's the paradox. Once your analysis confirms the opportunity, hesitation becomes your enemy. When the market speaks, I act with absolute conviction. No half measures, no second guessing. I put on the full position my analysis justifies. I've watched thousands of traders do the opposite. They trade impulsively without patience, then hesitate when real opportunity presents itself. They take profits too quickly on winners and hold losers too long. They've inverted the entire formula for success. My rule is simple. Be patient until the opportunity is clear. Then be decisive in your execution. This discipline separates the professionals from the amateurs. Remember, the market doesn't reward activity. It rewards correctness. I've made more money sitting still than most traders make, frantically buying and selling. There were entire quarters where I didn't place a single trade, preserving capital while others hemorrhaged money trying to force opportunities. The patience paradox requires emotional mastery. You must overcome the psychological need for action, the fear of missing out, the anxiety of waiting. This is why so few master it. It's not an intellectual challenge, but an emotional one. Master this paradox, and you'll find yourself on the right side of trades more often than not. Patient analysis, decisive action. This principle alone has been worth millions to me. Let me tell you about the warning signs I discovered before the panic of 1907, signals that saved my fortune while others lost everything. I've always paid attention to what the market tells me, not what the newspapers or other speculators claim. The market speaks its own language, and I learned to listen. In early 1907, I noticed something peculiar. Union Pacific and several other railroad stocks couldn't hold their advances. They'd rise on good news, then mysteriously sell off. I watched this pattern repeat for weeks. Most traders ignored it, focusing instead on the bullish headlines and economic optimism. But I knew better. I've developed a sixth sense for when the market is lying. When prices don't respond appropriately to positive news, I become immediately suspicious. This divergence between news and price action is my first and most reliable warning sign. In 1907, while newspapers trumpeted prosperity, the market was whispering warnings to anyone willing to listen. By March 1907, I had liquidated my long positions and established substantial short positions. My brokers thought I was insane. "Livermore," they'd say, "the economy is booming." But the market's behavior told me a different story. The second warning sign appeared when market leaders, the strongest stocks that had been driving the bull market, began to falter. In 1907, it was the copper stocks that first showed weakness. When I see former leaders start to lag, I know the market's character is changing fundamentally. My third warning sign came from the banking sector. Trust companies were expanding rapidly, making increasingly risky loans. The smart money, the professional operators, was quietly distributing stock to the public. Volume increased on declines and decreased on rallies, another critical signal I never ignore. When October 1907 arrived and the panic erupted, I was fully prepared. While others faced ruin, I made millions, not because I'm smarter, but because I respected these warning signs that had appeared months earlier. These same signals have preceded every major market break I've witnessed. They appeared before the 1929 crash and numerous other declines. The pattern is remarkably consistent: divergence between news and price action, weakness in market leaders, and distribution by smart money. I don't predict market crashes. I simply observe the market's behavior and respond accordingly. When these warning signs appear, I don't argue with the market. I adjust my positions immediately, regardless of prevailing opinion. This discipline has saved me repeatedly throughout my career. Remember, the market will tell you when it's about to change, but only if you're willing to listen. Rule number 2 of my trading system is what I call the pivotal reversal strategy. I developed this approach during the years leading up to the 1929 crash, and it saved me millions while others lost everything. I want you to understand this principle clearly, because it's the difference between being wiped out and walking away with profits when markets change direction. When I identify a pivotal point in the market, I don't hesitate. I reverse my position completely. Most traders make the fatal mistake of averaging down or holding on to losing positions. I never do this. When the market speaks, I listen and act decisively. In 1929, I watched the market reach dizzying heights. The public was intoxicated with stocks, buying on margin and speculating wildly. But I noticed something in September that others missed. The leading stocks were no longer making new highs. The market was telling me something important. I remember sitting in my New York office studying my charts. The industrial averages still looked strong, but the market leaders were weakening. This divergence was my signal. I closed my long positions and went heavily short. Within weeks, the market began its historic collapse. By October 24th, what they later called Black Thursday, I had already positioned myself to profit from the decline. When others panicked, I remained calm because I had already made my pivotal reversal. I didn't fight the market's message. I embraced it. My strategy isn't about predicting the future. It's about recognizing when the character of the market has fundamentally changed. I look for these signs: leading stocks failing to make new highs, increased volume on down days, narrowing market breadth, and divergence between related sectors. When I see these signals align, I don't debate with myself or seek confirmation from others. I act. I reverse my position completely and size it appropriately to the opportunity. Remember this: the market will give you clear signals before major reversals if you're paying attention. Most traders miss these signals because they're emotionally attached to their positions or narrative. I've made millions by recognizing pivotal points and acting on them without hesitation. In 1929, this strategy not only preserved my capital, it multiplied it while fortunes were being destroyed all around me. The pivotal reversal strategy requires both technical awareness and psychological discipline. You must train yourself to recognize the signals and have the courage to act against the prevailing sentiment. This isn't easy, but it's essential for survival in this business. My third rule is what I call the confirmation principle, and it saved me from disaster in Chicago back in 1921. The market had been rallying for months after the post-war depression, and everyone was jumping in with both feet. But something felt off to me. I'd developed a habit of looking for confirmation across multiple indicators before making significant moves. When I examined the wheat market, the price action looked bullish, but volume wasn't increasing proportionally with the rise. This discrepancy triggered my internal alarm. Here's what most traders miss. A genuine market move requires confirmation from at least 3 independent sources. I look for alignment between price action, volume, sector strength, and market breadth. When these elements tell different stories, I step back. In Chicago, while the price chart screamed buy, the volume patterns whispered caution. More importantly, insider activity showed the smart money quietly distributing their positions. The third confirmation came when I noticed that related agricultural commodities weren't showing similar strength. I immediately reversed my position and went short. Within 3 weeks, wheat prices collapsed by 18%. While others were devastated, I walked away with a substantial profit. This wasn't luck. It was the disciplined application of my confirmation principle. Let me be clear. Waiting for confirmation doesn't mean waiting until the opportunity is gone. It means having the patience to verify that what you're seeing is real. The market creates illusions constantly, designed specifically to separate you from your money. I've refined this approach over decades. When I spot a potential trade, I force myself to identify at least 3 separate confirmations before committing capital. These might include, first, price breaking through a significant level with conviction. Second, volume increasing to support the move. Third, related sectors or stocks showing similar patterns. Fourth, market breadth expanding in the direction of the move. Only when multiple factors align do I enter with size. This approach kept me alive through the panic of 1907, the crash of 1929, and countless smaller corrections. Remember this: the market will always present more opportunities than you have capital. Missing a move because you waited for confirmation is infinitely better than being caught in a false breakout. The IAO confirmation principle isn't about being right all the time. It's about being wrong less often and with smaller consequences. I learned this lesson the hard way in Chicago, but it served me well ever since. Confirmation before action. This principle alone would have saved most failed traders from their demise. In 1915, Boston was where I learned perhaps the most valuable lesson of my trading career. I call it the liquidity preservation technique, a principle that saved me from total ruin more times than I can count. Let me explain exactly how it works and why you need it in your arsenal. The markets had been exceptionally volatile that year. I'd made a fortune shorting stocks during previous downturns, but this time was different. I found myself over-leveraged in several positions that suddenly moved against me. The pressure was immense. Here's my rule: never commit more than 20% of your capital to any single trade, regardless of how certain you feel. This isn't about confidence. It's about survival. I've watched countless brilliant traders destroy themselves by going all in on sure things that weren't so sure. When I first implemented this rule, I felt like I was leaving money on the table. In April 1915, I identified what I believed was a perfect short opportunity in the copper market. My analysis showed a major supply glut coming, and every fiber of my being wanted to maximize my position, but I forced myself to limit my exposure to 20%. The market initially moved in my direction, making me regret my conservatism. Then came the unexpected, a massive government order for copper munitions for the war effort. The price exploded upward. Had I gone all in as my instincts demanded, I would have been wiped out completely. Instead, I took a manageable loss and preserved my capital to fight another day. 3 months later, I made back triple my loss on a different trade. The mathematics of recovery demands this discipline. A 50% loss requires a 100% gain just to break even. An 80% loss requires a 400% gain. These are the brutal realities of trading. By preserving liquidity, you give yourself the opportunity to recover. I implement this technique through strict position sizing and predetermined exit points. Before entering any trade, I calculate exactly how much I can afford to lose without compromising my overall trading capacity. Most importantly, I maintain at least 50% of my capital in cash or highly liquid instruments at all times. This reserve isn't just protection, it's ammunition for when genuine opportunities present themselves. Remember this: the best traders aren't those who make the most on their winners. They're those who lose the least on their losers while maintaining the ability to stay in the game. Liquidity preservation isn't just a technique. It's the foundation of trading longevity. The market doesn't reward the bold. It rewards the disciplined. I've learned this truth through painful experience, so you don't have to. Rule number 4 is the one that saved me more times than I can count. Liquidity vanishes first. Before the crash, before the headlines, before the panic, the smart money quietly disappears. I learned this lesson the hard way during the panic of 1907, and it's shaped my trading ever since. In early 1907, I noticed something peculiar. Trading volume in certain stocks was drying up, particularly in copper and railroad shares. The bid-ask spreads were widening. Orders that would normally be filled instantly were taking longer. These weren't obvious signals to most traders, but to me, they were red flags, waving frantically. I started shorting the market aggressively. My colleagues thought I was insane. Livermore's lost his mind, they whispered. The Dow was still near its highs. Newspapers were optimistic, but I wasn't watching the headlines. I was watching the liquidity. By October 1907, when the Knickerbocker Trust Company collapsed and panic swept Wall Street, I was already positioned. While others scrambled to exit positions in a market with no buyers, I was calmly taking profits on my shorts. That single decision made me over $1 million in a day, equivalent to about $30 million today. Here's what I look for. First, declining volume on rallies. When prices rise but volume doesn't confirm, that's your warning. Second, widening spreads between bid and ask prices. Third, institutional selling disguised as strength, large blocks being carefully distributed during rallies. I've watched this pattern repeat in every major crash, 1929, 1987, 2008, and most recently in 2020. Before the headlines hit, before retail investors panic, liquidity starts to evaporate. The smart money, the insiders, the institutions, they're already heading for the exits. Most traders are reactive. They wait for the news. By then, it's too late. You're trying to sell when everyone else is selling, and there are no buyers. I've always been proactive, watching the early warning signs that others ignore. Remember, markets take the stairs up, but the elevator down. When liquidity dries up, that elevator can drop with breathtaking speed. I've made some of my biggest profits by being positioned before the drop, not reacting to it. This isn't about predicting crashes. It's about reading the market's vital signs. When liquidity starts to vanish, it's telling you something important. In my 50 years of trading, ignoring that message has been the costliest mistake I've seen traders make. Rule number 5 is what I call the confirmation signal, and it's the reason I made millions during the 1929 crash, while others lost everything. When I spot a potential market move, I never act on my first instinct alone. I wait for the market to confirm my suspicions through price action. In September 1929, I noticed something deeply troubling. The market had been soaring for years, but underneath the euphoria, I saw weakness. Steel production was declining. Automobile sales were slowing. Construction was down. These fundamentals contradicted the market's relentless climb, but I didn't short immediately. I've learned that lesson the hard way. Instead, I waited patiently for my confirmation signal. When the market tried to rally, but couldn't sustain the momentum. By early October, I observed 3 failed rallies in succession. Each one reached a lower high than the previous. That was my confirmation. The market wasn't just pausing, it was exhausted. I began building my short positions methodically, not all at once. That's amateur behavior. I scaled in as each confirmation signal strengthened my conviction. By October 24th, what they later called Black Thursday, I was heavily short. While others panicked, I remained calm. My analysis had been confirmed. I wasn't guessing. I was executing a plan based on verified signals. The confirmation signal works in both directions. In 1923, I lost over $3 million because I ignored my own rule. I saw bearish indicators, but jumped in before confirmation, and the market rallied against me. That mistake taught me discipline. Your confirmation signal might differ from mine. Some traders use volume patterns. Others watch sector rotation. The specific indicator matters less than the discipline of waiting for it. The market will tell you when it's ready to move, if you're patient enough to listen. Remember, the market doesn't reward impatience. It rewards those who can resist the urge to act prematurely. I've made my greatest profits not by being first, but by being right, and being right requires waiting for confirmation. During the 1929 crash, many traders saw the same warning signs I did. The difference? They acted on fear or greed. I acted only when the market confirmed my analysis. That's why they lost fortunes while I walked away with millions. The confirmation signal isn't just a trading technique. It's the difference between gambling and strategic market operations. Rule 6 of my trading system is something I paid for with blood. Scale in, don't plunge. Early in my career, I'd see an opportunity and throw everything at it. When I was right, I'd make a fortune. When I was wrong, I'd be wiped out. It took me 3 bankruptcies to learn this lesson properly. Here's how I approach position sizing now. I never commit more than 10% of my capital to a single initial position. Never. The market will always be there tomorrow. There's no rush to deploy all your ammunition at once. When I identify a potential trade, I start with a pilot position, just enough to get my skin in the game. This does 2 things. It forces me to pay attention, and it gives me real-time feedback from the market itself. If the position moves against me immediately, I've limited my exposure. If it moves in my favor, I have the option to add. The scaling approach creates a virtuous cycle. When I'm right, I add to my position as the market confirms my thesis. I call this trading with the house's money. By the time I have a full position, the market has already validated my analysis multiple times. In 1907, during the panic, I started with a small, short position in Union Pacific. As the stock continued to fall, I added to my position. By the time the stock collapsed completely, I had built up a substantial position, but I never risked everything on my initial analysis. The market confirmed my thesis before I committed significant capital. I've also developed what I call my thirds rule. I divide my intended position size into thirds. The first third is my pilot position. If that moves in my favor, I add the second third. Only after further confirmation do I add the final third. This approach kept me alive during the 1929 crash, when others were wiped out. Remember this: the biggest positions should come from profits on existing trades, not from your initial capital. Let the market pay for your increased exposure. Most traders get this backward. They start with their largest position, then scale down as losses mount. That's the path to ruin. I know because I walked that path myself multiple times before I learned better. The market will give you many opportunities. Your job isn't to catch every move with maximum size. It's to survive long enough to catch the big ones with appropriate size. Scale in, don't plunge. Your trading account will thank you. Rule 7 is perhaps my most important. Know when to exit. This rule saved my fortune in 1929 while others lost everything. The exit is where most traders fail. They have no plan, no discipline, and ultimately no profits. I developed my exit strategy through painful lessons. In 1907, I made millions shorting the market, but in 1908, I gave it all back because I stayed too long in my positions. By 1929, I had learned my lesson. My exit strategy begins with predetermined price targets. Before I enter any trade, I know exactly where I'll exit, both for profit and for loss. This isn't arbitrary. It's mathematical. When I shorted the market in 1929, I had calculated where the market would likely find support based on previous consolidation areas. I watch for divergence between price and market behavior. In September 1929, while stocks were still making new highs, trading volume was declining. The railroad stocks, which typically lead the broader market, had already begun falling. These divergences were my signal to begin exiting. I also pay close attention to market sentiment. When taxi drivers and shoe shiners started giving me stock tips in 1929, I knew the top was near. The public entering en masse is almost always the final stage of a bull market. When everyone is optimistic, there's no one left to buy. My scaling technique is crucial. I never exit all at once. I scale out of positions. In 1929, I began taking profits in August, continued through September, and was completely out by early October. The crash came on October 24th. By scaling out, I captured most of the move while eliminating the anxiety of trying to pick the exact top. The hardest part of exiting is psychological. You must overcome greed. When I started exiting in 1929, the market was still rising. Friends called me foolish, but I wasn't trying to squeeze the last dollar from the move. I was protecting my capital. Remember this: the market will exist tomorrow, next week, next year. There will always be another opportunity. But if you lose your capital by failing to exit properly, you can't play the game anymore. My 1929 exit strategy made me $100 million in today's dollars, not because I predicted the crash exactly, but because I recognized the conditions that preceded it and had a disciplined exit plan. The amateur focuses on entries. The professional focuses on exits. Master this rule, and you'll survive to trade another day, which is the first requirement for long-term success in this game. My sixth rule is perhaps the most critical of all: psychological fortitude. I've made and lost several fortunes throughout my career, and I can tell you with absolute certainty that your mind will break before the market does. During the 1929 crash, while others panicked, I remained calm and methodically executed my short positions ultimately making $100 million because I had developed the mental discipline to follow my own rules. When I look back at my worst losses, they never came from following my system. They came from moments of weakness when I let fear, greed, or ego override my better judgment. In 1908, I lost nearly everything because I abandoned my principles and traded impulsively. The same happened in 1915. Each time, the market was simply doing what markets do. I was the variable that changed. Psychological fortitude isn't about eliminating emotions. That's impossible. It's about recognizing them and preventing them from infecting your decision-making process. I developed specific routines to maintain this discipline. Before major trades, I would isolate myself in my office at the Sherry Netherland Hotel, reviewing my notes and confirming that my analysis aligned with my trading rules. This separation from the noise of Wall Street was essential. I also kept detailed trading journals, not just recording entries and exits, but documenting my emotional state during each decision. This practice helped me identify dangerous patterns in my thinking. When I noticed myself rationalizing positions contrary to my system, I knew my psychology was compromised. The market doesn't care about your hopes, fears, or financial obligations. It will not bend to your will or offer mercy when you're desperate. This reality breaks most traders because they take the market's movements personally. I learned, painfully, to view price action as simply information, not validation or rejection of my worth. Remember this: your greatest enemy isn't bearish trends or bullish euphoria. It's the face in the mirror. In 1929, while others were jumping from windows, I maintained my composure because I had prepared my mind, just as diligently as I had prepared my trading strategy. Develop routines that reinforce discipline. Create distance between market events and your reactions. Document your thinking to spot psychological weaknesses. And most importantly, accept that mastering your mind is a lifelong process. I'm still working on it after decades in the markets. The battle never ends, but with each victory over your psychological weaknesses, you move one step closer to consistent profitability. Rule number 7 is perhaps the most valuable indicator I've ever developed. Volume precedes price. I call it my ultimate crash indicator, and it saved me millions during both the 1907 and 1929 crashes. Let me explain exactly how it works. I first noticed this pattern in 1906 while tracking railroad stocks. The market appeared strong on the surface, but I observed something critical. Trading volume began declining while prices continued rising. This divergence, this disconnect between volume and price, signaled weakness beneath the surface. By early 1907, I was fully positioned short. When the market finally collapsed that October, I made over $1 million in a single day. Not because I was smarter than others, but because I recognized this pattern while they focused solely on price movements. The pattern repeats with remarkable consistency. Volume is the footprint of money. When prices rise but volume decreases, it means fewer participants are driving that movement, a dangerous situation. The opposite is also true. When prices fall on increasing volume, a bottom is forming. I refined this indicator throughout the 1920s. As the market soared to unprecedented heights in 1928, I noticed the same telltale signs. Stock prices continued climbing, but trading volume became erratic, then began declining on rallies. The smart money was quietly exiting. By September 1929, the divergence was unmistakable. I went short again, in size. When the crash came in October, my positions returned over $100 million in today's currency. Again, not because of some mystical foresight, but because I trusted this indicator above all else. Here's how you apply this principle. Track volume alongside price. When you see prices making new highs, but volume failing to confirm those highs, prepare for reversal. The bigger the divergence, the more significant the coming move. Many traders make the critical mistake of watching only price action. They see stocks hitting new highs and assume strength. I've learned, through painful losses early in my career, that price alone tells only half the story. This principle works across all time frames and markets. Whether you're trading stocks, futures, or currencies, volume precedes price. It works on daily charts and monthly charts alike. I've used this single indicator to anticipate every major market turn in my career. Master this principle, and you'll possess something more valuable than any hot tip or insider information. You'll see what others cannot. The invisible hand of major players positioning before price movements reveal their intentions. My methods have endured for nearly a century because markets reflect human nature, which never changes. Fear, greed, hope, and ignorance still drive prices just as they did in 1929. The technology changes, but the game remains the same. Let me show you how my 7 rules apply in today's markets. First, my principle of pivotal points remains essential. In 2020, when markets crashed during the pandemic, the S&P 500 found support at 2,200, a critical pivot. I would have recognized this as a major buying opportunity, not a time to panic. Those who understood pivotal points accumulated fortunes while others fled in terror. Second, my rule about never averaging down saved countless traders during the 2022 bear market. Those who kept buying the dips in speculative tech stocks only multiplied their losses. When the trend changes, accept it immediately. Your opinion means nothing against the market's verdict. Third, my patience principle serves traders well in today's algorithm-dominated environment. The market gives you nothing when you demand something from it. During the 2021 meme stock frenzy, I would have waited for the emotional excess to burn itself out before positioning myself. Patience is even more valuable in an era of instant information and lightning-fast trading. Fourth, my capital preservation rule remains sacred. Look at Archegos Capital's collapse in 2021. A perfect example of what happens when you ignore position sizing and risk management. They lost $20 billion in days. I never would have allowed a single position to threaten my trading capital. Fifth, my rule about following the path of least resistance works perfectly with today's technical analysis tools. The 2009-2020 bull market provided a clear uptrend to follow, while Bitcoin's 2022 breakdown below $30,000 signaled a powerful downtrend that destroyed those who fought it. Sixth, my principle of trading only when conditions are right saved fortunes during the 2018 and 2020 volatility spikes. When VIX exceeds 30, I reduce exposure and wait for clarity. The market rewards those who preserve capital during chaos. Finally, my rule about emotional detachment matters more than ever in the social media age. Today's traders face an unprecedented barrage of opinions, rumors, and noise. The disciplined few who trade their plan rather than their emotions still find the success that eludes the masses. The market remains the greatest teacher for those willing to learn its lessons. My methods worked in 1907, 1929, and they work today because they're built on the unchanging foundation of human behavior in markets.